The very first phone call is very low risk because at the end of the day, chances are your client is not going to be making a decision on any type of services with you after just hearing your voice for the very first time. Our goal in the first phone call is to really identify if that client that you're on the phone with is truly an ideal client that you can work with, an ideal client that you can provide value to. And we want to make sure that that client is actually in tax compliance. Do they have all of their tax returns filed? Are they someone who can do tax planning with us right now, or they're going to have to file tax returns and wait to do tax planning with us? So this is important. When we start off the call, we want to give our clients the floor so we can turn on our listening ears. When you get on the phone with the client, it is important that you identify who you are, that you thank your client for taking the time to have the call with you, and that you immediately flip the table and ask your client, what are the reasons why you scheduled a tax strategy call today? Just asking that question is going to open up a floodgates of opportunity, and it's up to you to make sure that you extract the right information. The information that you're looking for is really your client's demographic. You want to hear more about your client. Are they telling you a little bit about their family? Are they telling you about some past stress that they're dealing with, maybe with a past tax accountant or a past tax incident? Are they talking about their business right away? Are they passionate to tell you already what their business is and what their services are and what they're selling? These are the things that you're looking for. You want to establish a bond immediately with your client, a connection. And what you need to do is you need to make sure that you sound extremely interested in everything that your client is saying, but not overly interested to the point where your client can sniff that out from a mile away. You want to be genuine. And genuine comes from this process that we've created. When you ask your clients, what made you schedule a tax strategy call today? Your clients are going to be pretty transparent about some of the things that are going on in their life. Maybe they feel like they're leaving a little bit of money on the table. Or maybe they feel like their accountant that they're working with right now isn't communicating at the level that they want that accountant to communicate to. This is where the opportunity starts to come in. Don't jump on every little thing that you hear and start running in that direction. Simply stick to the script that we have laid out for you. Your next goal is to start extracting information. But you want to first confirm and make sure that your client has identified that you've heard them. Tell your client, I hear you. So from what I heard, you want to make sure that you're working with a tax accountant that hears you. Your business is growing. You want to make sure you have the correct business structure. Okay, I'm hearing you. If you don't mind, tell me a little bit more about your business. How long have you had it? What services do you sell? Oh my goodness, how did you get into this? What got you started in selling candles or making popcorn? These types of engagement get your clients to relax. They no longer feel like they're talking to an uptight tax accountant. They feel like they're talking to a friend. And the more comfortable they feel, the more comfortable they're going to feel to purchase from you later on once they truly see the value from you. So it's so important in this first phone call that we take our time and establish this connection with the client. As you continue to hear your client talk, you can start to invite in more of the questions in our sales script, such as how their business is structured. Is it a sole proprietorship, an LLC, an S corporation, or a C corporation? Are you on payroll? Are you paying yourself? Oh, so you're not paying yourself. Okay, got it. Oh, so you're managing your real estate. Okay. Do you happen to have a management company where you're charging yourself management fees for managing your own real estate? What we want to do is kind of like what we do when we're scheduling a very first call. We want to use quick little strategies to reel our client in, but we also want to identify that our client is the right type of client. If you remember, in our qualifying questions, we are looking for clients that have a business or clients that have rental real estate. So as you start to extract this information from your clients, you will start to learn more about that business or that real estate. But if they don't have a business or don't have real estate, then our next purpose of this call is to immediately figure out what our client's intentions are with the call. And that's something that we can ask right away. Sir, ma'am, what are you trying to get out of this call today? Hearing what they're going to tell you is so important because now they may tell you, I'm looking to start a business, or I'm looking to align with a new accountant to file my tax returns with. This is important for us to know because we are not in the business of helping people start new businesses and giving them ideas. We are in the business of providing tax strategies to clients with businesses in real estate that are making income. However, if we have clients that haven't started their businesses or don't own investment properties yet, it is very hard to offer tax saving strategies if there's no tax to save on. So it's very important that we identify the right types of clients when we're going through this first call. If your client tells you, hey, I'm looking to start a business, or I want to work with a new tax accountant, it's important that we let them know who we are. That is great. I'm glad that you're looking to start a business. We work with a lot of new business owners. It is so important that you get the correct structure starting out. Have you already established your entity structure? The reason why we want to pivot out of selling tax planning is because if we are working with a client that has not established a business structure yet, then they're a client that we cannot sell tax planning to yet. Our clients who we work with need to at least have a sole proprietorship already established, a business idea with goals behind it and revenue ready to come in. However, if the client has not even established a sole proprietorship or an LLC, then this client may not be your ideal client. So now it is up to us to make sure that we can transition to get off the phone in the most advantageous way without looking like we are a salesperson trying to get off the phone very quickly with someone who's unideal. So how do we do this? When you're working with a client that is trying to start a new business, it is important that you flood a client with information. This does a number of different things to the client. One, it puts them in a position where they have to go seek out more information. Two, it puts them into a position where they realize why they cannot move with you. And three, it puts them in a position where they can't keep asking you questions. One of the things that you might get annoyed with is that clients will constantly ask and ask questions. But a part of our sales process is to identify the right clients so we can immediately take control of the call. And one of the things that we need to stick to is sticking to these questions to identify the clients who aren't ideal so we can get them off the phone without them just rattling off question after question after question, sucking up the valuable time that could be spent working with your ideal client. The purpose of the first phone call is to establish trust with your client and to extract the right information. We want to get to a second phone call where we have the tax returns from the client so we can provide them with the tax savings that they can receive, and then we can explain the process of tax planning so they can quickly onboard and we can make a sale. But as we go through this first call, it is important that we ask the right questions. When you have a call scheduled on your calendar, you may already have the little questionnaire filled out. So you can already identify what your client's occupation is, the income that they have, and some small tax concerns that they may already have. It is important that you read through this. You want to identify the clients who are earning smaller amounts of income versus the clients who are earning more, bigger amounts of income. Typically, the clients who are earning more income are going to be your greater clients, but it's important that we fish out those clients who are earning smaller amounts of income because there's still opportunities for us to provide them tax planning services. As you go through the first call, the first thing that you want to do is you want to ask your client, what is the reason that made you schedule today's call? When you do this, your client is given the floor. It's an opportunity for your client to flood you with information that you need. They may tell you immediately what type of business that they have, how much income that they're earning, the problems that they're dealing with their current CPA, or why they might be on this phone call with you. After you hear this information, you want to thank them for sharing that, but you also want to repeat back some of that information. For example, if your client is telling you part of the reason why they scheduled the call today is because they haven't worked with the CPA that focuses on business tax strategies, then you want to tell the client, well, I'm glad you're giving me the opportunity to work with you. We happen to focus on a lot of tax strategies for small-based business owners, and I want to make sure that I can provide you with strategies that are actually going to save you money. Tell me a little bit more about your business. Utilizing what your client said and complimenting them at the same time is what we call appealing to your client's pride. we want to make sure that we appeal to their pride immediately from the start because it establishes trust, but it also establishes an emotional connection. When we head into our second call, our clients are going to remember some of these things that we said and the type of connection that we've established by the way we communicate. After your client has shared some of this information with you, your mindset needs to shift into qualifying. It is our goal to make sure that we are extracting the right information to determine if our client is worthy of having a second consultation. And if our client is not worthy of having a second consultation, then we will continue to address their questions over the phone, but our real intention is to get off the phone as fast as we can. One of the things that we need to be mindful of is if our client has a business and has real estate. If our client does not have a business or does not have real estate, this should be a red flag. If our client is just starting a business, then we need to know how much income our client is potentially going to make in that current year to know how much we can save them from a tax planning perspective. But if your client does not have the ability to generate income in the current year or the ability to purchase real estate in the current year, then this is considered a non-ideal customer. Our goal is now to get off the phone in the fastest way possible without being rude. And how we can do this is making sure that we talk from a high level place. When your client is a new business owner, you want to actually get excited. You don't want to get bummed out to the fact that they don't have a business yet or don't have real estate yet. You want to get even more excited for this client. I typically will flood a client with a lot of information because when I do this, rather than staying on the phone for the full 30 minutes or the hour consultation, I am able to get off the phone a lot quicker in 10 or 15 minutes because I flooded the client with information that they need to go and do before they can come back and have a tax strategy consultation with me. For example, I may tell a new business owner to go read the Rich Dad Poor Dad series on the guide to investing, just so that they can learn a little bit more about how income is taxed and the different cash flow quadrants that are out there. I may tell a business owner to learn a little bit more about self-employment tax and learn a little bit more about the differences between a sole proprietorship, an LLC, and an S Corp before setting up a business. What this does is it gives the business owner some homework to go and do as they get ready to start their business off. One of the things that we want to position ourselves as is we want to position ourselves as the strategist. And as a tax strategist, we help out business owners and real estate investors who are making income by helping them reduce their income with the strategies that we provide. However, if we have a client that is not planning on making income in the current year or planning on purchasing real estate in the current year, it is important that we immediately identify this and identify that we cannot sell them on a service. Now that you've asked the right questions with your client and you've identified that this is a client that you can provide value to, one of the things that you need to do is transition into the second call. How you do so is by letting your client know that you're a strategist that wishes to review their returns for opportunities to reduce their tax bill in real time. Here's how it goes. If you don't mind, I would like to schedule another call where I have the opportunity to review your tax returns to inform you of the amount that we could potentially save you, not only in this year, but in possible previous years of returns that have been filed. Would you be open to a second consultation? This is giving your client the opportunity to meet with you again, a free opportunity for you to review the tax returns to determine how much tax savings you can provide to the client, and for your client to hear about where they could have overpaid on their taxes for free. It's going to be very hard for your client to say no to this, but if they happen to say no to this, you want to be now persistent on establishing the next appointment. Part of the reason why is without having those tax returns, it's going to be hard to determine how much you can save a client unless they're giving you all of the information that you need over the first call. This information is the amount of gross income that the company has made or that the real estate has made, the amount of net income that the company has made or that the real estate has made year to date, as well as any financial decisions that the client is planning on making before the end of the year. You see, this is when we can start heading down a road that could lead us falling out of a sale. So in order to make it very easy and transition into a process where we can sell the client easily, we want to get the tax returns and go through our process with the client. So one of the things that we want to be persistent on is letting the client know that we are a strategist, and in order to save a client, we have to look at the tax returns, just like a doctor has to look at your blood type and your blood pressure before he can prescribe you medication. Calling to confirm an appointment. After you've already established your first phone call with your client, you now have a second appointment on the calendar where you have access to the tax returns. You want to call to confirm that your client is ready for that call. When you call to confirm an appointment, you want to thank your client for making the time for that call, identify that your client has completed the questionnaire, but also you want to review that your client has already uploaded the tax returns to the portal. If your client has not uploaded the tax returns to the portal, this is a chance for you to remind your client that they have 24 hours or 48 hours, depending on how soon you've confirmed the appointment, to upload the tax returns so you're prepared for the call. One of the things that we want to do when confirming the appointment is making sure the clients understand the severity of the tax return. This is like a key to us seeing how much the client is earning and how much we can save them on tax dollars before we even get on the phone with them. So you want to make sure that the client has taken this call seriously. If the client says that they don't have access to their tax returns, this leads to a new opportunity. Maybe the client needs tax representation because they haven't filed their tax returns before. Maybe the client is in a position where they need to file their taxes. You need to make sure that you identify the reasons why your client does not have the tax returns at that current moment. And if they're no longer a tax planning client, then you can pivot to sell other services. When you are calling to confirm an appointment and your customer does not answer the phone, it's important to leave a solid voicemail. I typically will leave a voicemail saying my name, the company that I'm calling from, and the reasons why I'm calling, followed by my contact information. But also, the reason I will say why I'm calling is to confirm that they have the ability to upload the tax returns to the portal prior to the call. The tax returns are 75% of the work. The other 25% is just making sure that we sell the sales script the right way. So if you can get access to those tax returns ahead of time, you're going to put yourself in a position where you know how much value you can provide to your client in the form of tax savings. Let's go over a sample voicemail. Hi, Mr. Johnson. This is Karlton from Karla Dennis and Associates Tax Office. My contact number is... The reason why I'm calling today is I wanted to confirm our appointment for Thursday, April 22nd at 2 o'clock Pacific Standard Time. When you get a chance, please make sure to upload a copy of your 2019 tax returns to your portal. If you have any questions or you need to reschedule, please give me a call. Thank you so much and have a great day. Anytime you're leaving a voicemail to the client, you want to make sure that you're giving the contact information at the beginning of the call, but also giving the contact information at the end of the call. If your client's a busy person, they will understand who you are and extract the contact information immediately and call you back. But if there's someone who has more time, they'll listen to the rest of your call, and then you can always leave your contact information at the end of the call. This is exactly how you would want to leave a voicemail to a potential customer. Reviewing the application. Reviewing the application is important for me because I like to be prepared for the call before I go into it. Typically on the first phone call, I already know the person's annual income because they've entered that on the questionnaire. Typically, I can see if they're a six-figure earner, if there's someone who's making less than six figures, and I can also tell what their occupation is. Anytime I see a new business owner, I can typically tell because sometimes they'll put down as their occupation W-2 plus self-employed. This doesn't mean that they're not going to be an ideal client for me. It just means that I know that they have W-2 income plus self-employed income. Also, on the questionnaire, we can identify if the client owns rental properties or if the client has an entity such as an LLC or a corporation. Knowing what my client's entity structure is ahead of time allows me to be prepared going into the call. And sometimes your clients want you to read that before you get on the phone with them so that you're aware of the reasons why they're on the call. So it's important that you're reading through this questionnaire, but from a tax strategy perspective, you want to look at this questionnaire and already identify if your client's going to be someone you can sell. Maybe you can see in their email account how passionate they are. Maybe they have a professional business email account, Joe Schmo at Joe's Plumbing or HG Realty Home Team. It's so important that you're identifying all the characteristics as a part of this questionnaire because when you go into a call, this is your ammunition that you get to use as you sell the client. Now, keep in mind that you're a tax strategist, so we are looking for income and problems. If your client is putting in the description that they're dealing with a tax problem, they have to pay, or that they're not getting the help that they need from their CPA, then this is when we can step in and provide our strategies as the opportunity and bridge the gap as their new accountants. Going over the application. Going over the application before your call is so important, and you get this typically in the form of an email. When the application comes over to you, it's going to share with you some things. Typically, it's going to let you know your client's first and last name, your client's occupation, as well as whether or not your client happens to have a business or a tax concern. It is so important that you first identify what your client's tax concern is. Maybe your client has a past tax issue, or maybe your client is just not getting the support that they need from their CPA. Most commonly, you'll get that your client just wants to see if there's any other tax strategies or nuances that they might not be aware of. This is all opportunities for you to step in as a strategist and provide them value. But one of the things that we need to make sure that they're a client that we can provide value to, which is the purpose of even having this questionnaire. We get to see a little bit of their income. You will see that a client can put down their income. However, the tax returns can tell a whole different story. This is why it's important that we stick to our qualifying questions, because it'll lead us through the process to make sure that we're only selling the clients that we can truly provide value to and not wasting time on clients that we really can't provide value to. Also, on the occupation, you may see that a client puts W-2, self-employed, or W-2 plus self-employed. This gives you the ability to know a little bit more about your client's household and whether or not that they have a single income or a dual income in the household, or maybe if your client's working as a sole proprietor or a self-employed individual, but also working in their own job. Now, you and I both know that a business owner that's committed to their business full time is typically a business owner that can benefit more from the tax code because they're probably making more income and they probably have more skin in the game. However, we have identified and worked with tons of business owners who are running side hustles, and they need just as much tax planning help as the big boys. So it's so important that you read through this questionnaire very carefully and that you start to identify whether or not this client will be someone who you can potentially sell on. Keep in mind that you're looking for a real estate investor and a business owner as your ideal client. Welcome to the introduction to the Tax Pro Grow sales script. As a part of the introduction, you'll be repeating back the same thing that was stated in the very first phone call as the introduction. When you get on the phone with a prospective client, it's important that you identify yourself and thank the client for being on the phone with you. So let's jump into a routine sales call. Hi, Mr. Johnson. Hi, who is this? This is Karlton with Karla Dennis and Associates Tax Office. How are you doing today? I'm doing well, Karlton. How are you? I'm doing great. Thank you so much for asking. If you don't mind, Mr. Johnson, I want to start off the call by saying thank you for scheduling this appointment and for taking the time to upload a copy of your tax returns. I have already had the chance to review them. If you don't mind me asking, tell me a little bit more about yourself and what led you to scheduling a tax strategy call with me today. You see, when you do this, you're letting your client know that you've already reviewed their tax returns, you already know what you needed to see under the microscope, and now you want to really identify what are the true needs that your client needs to accomplish out of this conversation with you today. You are truly positioning yourself as a professional when you do this, and you're giving your client the microphone, the floor to tell us what it is that you need before I get to describe to you what it actually is that you need to change your life. So now we listen. Your client is going to explain to you some of those things that they need in their life. I'm growing my business. I'm getting ready to purchase a new property. Oh, I'm starting a trucking company. I'm getting ready to do day trading. You need to extract this information and write it down, because the next thing that we're going to do is we're going to go into our qualifying questions to determine if our client can be sold on tax planning. After we've gone through the introduction, the next step in the sales process is qualifying our client to see if we can pitch them on the tax planning services. Now, I know we already have the tax return. I know that we already know how much our client is overpaid, but sometimes the tax return doesn't paint a picture of how much our client is making this year or the assets our client has purchased this year. So it's still important that we ask the right questions. When you have already heard from your client the reasons why they scheduled the call, it's important that you thank your client for telling you those reasons and repeat back to them those statements. Okay, Mr. Johnson, so the reason why you scheduled this call today is because you want to make sure that you're not leaving any money on the table. You want to make sure that you have the correct business structure for your new business as a realtor, as a truck driver, as a mortgage lender. Anytime you're working with a business owner, they're gonna tell you some of the business things that they're worried about. And typically it's around their entity structure or themselves feeling like they're overpaying as a business owner. These are both great things because one, we've already looked at the tax return so we know what type of structure they have, or two, the tax return didn't tell us the structure so we can immediately go into qualifying questions. So let's dive in. When we go into qualifying questions, the first thing that we have to ask our clients is, okay, thank you so much for taking the time to have this call with me and for telling me a little bit more about your business. How long have you been in business? I want to know how long my client has had his business. And the reason why I want to know how long my client has had his business is because I want to know how long he's been going through the ups and downs. Business has a lot of ups and downs in it. It requires a tougher skin. And if you've been in business for longer than 2-3 years, then chances are that you realize that you are really committed to growing a business because you've suffered through some of the pain as it takes to being a business owner. So that lets me know a little bit more about you. I also want to know what type of entity structure does your business have? Is your business operating as a sole proprietor? Is your business operating as an LLC? Is your business operating as an S corporation or is your business operating as a C corporation? The reason why I want to extract this information is because I can immediately identify if a client has a sole proprietorship or an LLC, how much self-employment tax they're paying into by simply adding that number times 15.3%. We all know that self-employment tax is 15.3%. So if our client has a sole proprietorship or an LLC, then we can immediately identify if we can sell this client on tax planning based on how much self-employment tax that they're paying into already. The next thing that I want to know from my client is, do they have employees? And if so, how many employees do you have? Also, if you do have employees, how are you paying these employees? Are these employees getting paid via W-2, or are these employees getting paid via 1099? The reason why I ask this question is because understanding a little bit more about your client's business could lead to additional services later down the road. But simply asking the questions can put you in a position where you look like the professional. Not all of this information is going to be important for us for tax savings, but it's important for the client to know how important we are taking this sales call. So we ask these questions regardless of whether or not it's important for the tax savings. Also, what we want to ask our client is, do you plan on contributing to any qualified retirement plans such as a solo 401k, a SEP plan, or a traditional IRA? When you ask this question, it puts your client into a position where they have to let you know if they have a qualified retirement plan already set up for themselves in their business, if they're contributing to a qualified retirement plan on a yearly basis, or if they do not have something set up, which could be a strategy that you can implement as a part of the tax planning. Because any individual that has a business can set up a qualified retirement plan with their business and contribute money to their qualified retirement plan and receive a tax deduction for it. So we want to start checking off strategies in our head as we go through the qualifying questions. Also, with your client's business, does your client work from home or does your client have a storefront or an office setting where they're conducting business from? Part of the reason why we ask this question is because we want to know whether or not the client's making income to pay for a lease. Maybe they're renting or maybe they're living at home and they qualify to take a home office deduction and we didn't identify a home office deduction on the tax return. It is so important that we take the time to ask our clients, are they working from home and are they taking a home office deduction? Another question we want to ask our clients is, how do they write off their vehicle? There are different ways in which you can take a vehicle as a deduction. As a part of the Tax Cuts Jobs Act, Donald Trump implemented Code Section 179 that allows businesses who have business vehicles that weigh over 6,000 pounds that qualify under 179 to be able to take a deduction in 1 year based on the vehicle's purchase price. If we ask our clients the right questions, we can leverage this strategy for our clients. So it's important for us to understand how many vehicles our clients is using in the business and how are they writing off their vehicle. Are they taking actual expense, where they're taking all the expenses associated with their car? Or are they taking mileage and depreciating the car over 5 years? Once we have a better idea, we will know if we can utilize a vehicle in our calculation for our strategies. Qualifying questions for real estate investors. As we go through the qualifying questions for real estate investors, it's important that we extract information to determine whether or not this real estate investor has property that qualifies for a cost segregation study, or that they're managing their real estate property to enough to qualify for a management company. So as we go through these questions, keep those two strategies in mind. We want to be able to leverage a management company, and we want to be able to leverage a cost segregation study for accelerated depreciation. When you ask your client, hey, do you have any rentals? You need to make sure that your client is telling you how many rental properties that they actually have. Sometimes you'll deal with real estate investors that may tell you how many doors that they have. They may have 4 or 5 doors, but it may only be one property. So it's important that you ask how many actual properties that you have. And then follow that up with a second question by asking, how many units do you own? This will ensure that you're asking for the number of properties as well as the number of units. The third thing that we want to ask is we want to know how many of these properties were recently purchased in the last 5 to 10 years. The reason why we ask this is because most properties that are purchased in that type of time span qualify for the cost segregation study. However, if you purchase a property and you've been depreciating it for longer than 10 years, it's going to be hard to justify the benefits outweighing the cost to doing a cost segregation study. So it may not be a great strategy to recommend to your client. So we want to make sure that we're recommending tax strategies that are going to put our clients in a better position. So we want to identify those properties that have been recently purchased. Once you're working with a client that does have rental real estate, let's determine what type of asset protection your client has. The next thing to ask them is, hey, do you happen to have an LLC for your rental properties? And if so, how many LLCs do you have? Most clients you work with are hesitant to set up LLCs. And part of the reason why is they realize that there's certain fees with LLCs. They may have been told not to set up an LLC by their previous tax accountant before in the past, or they may have an umbrella policy insurance and they're unaware of whether or not they may need an LLC. This is just an opportunity for us to identify whether or not a client has the type of asset protection we would want them to have as a tax accountant and what they might be doing with their real estate from a management perspective. This leads us into our fourth question. Is our real estate investor managing his own rental property? Anytime a real estate investor is managing their own rental property, they could qualify to become a real estate professional. A real estate professional has the ability to leverage their rental losses to offset earned income from W-2 or other sources. So we want to identify if our client qualifies as a real estate professional. If they're also managing their property, they may not be charging themselves management fees for managing their own assets. This is an opportunity for us to establish another corporation or an entity structure where our client can be on payroll as well as their children could be on payroll through a management company that can help them reduce their tax bill. Not to mention, if they're managing their property, that means that they can take a home office deduction from their home where they're managing their property from. And if they have vehicles that are associated with that business, then they can leverage a vehicle deduction through their management company. This is a way for a lot of your real estate investors to be able to take deductions that they're not able to take on the normal Schedule E. And this allows for your real estate investors to leverage their real estate like a business so that they can continue to grow in this advantageous way of utilizing their rental losses. Door number one. Door number one is starting off with reviewing your client's history. You work just like how a doctor works. And anytime you go into a doctor's office, it's hard to get medicine right when you walk in. Chances are a nurse wants to see you first. And typically a nurse wants to review your medical history. Your nurse wants to look at your family history of heart disease, your blood rate, your heart rate. They want to look at a lot of different things to make sure that the doctor doesn't prescribe you medication that you might be allergic to. As a tax accountant, we want to review your history first. Part of the reason why we want to review your tax history first is because the IRS allows taxpayers up to 3 years to amend their tax return. If a taxpayer is given 3 years to amend their return, as a tax strategist, I want to see those last 3 years to see if there's any areas of opportunity that might have been missed by my taxpayer and see if the benefits outweigh the cost of us resubmitting a tax return to get X, Y, and Z amount of dollars that could have been left on the table. And at the very most, it'll be me doing my due diligence to make sure I understand what type of taxpayer my client is. This is what the purpose of reviewing the history is for. Door number 2, evaluating your current situation. After we've reviewed your history, it's important that we hop into your current situation. You may be starting a new business, investing in a rental property, hiring a new employee, or you might have seen a spike in income during this COVID or the situation that your client is particularly in. It's important for us to understand where you currently stand. And how we do that is by pulling your income and your expenses that you've had going back to January 1st up until today's date. Today is June 28th, 2020. I want to pull your income and expenses from January all the way up until June 28th. And with the remaining 7 or 6 months we have left in the year, we will do a forecast to determine what you're going to owe versus what you're going to receive back in a refund. By having this number, your liability, I now know the number I want to change. But before I change that number, it is so important that I understand the rest of your current situation. Starting off with your personal goals. I want to know, what are you trying to personally accomplish? Are you trying to buy a primary residence? Are you trying to get married? Are you trying to move out of the state that you're in into a different state? Do you want to save up for college for your children? These personal goals are just as important to me as your business goals and your real estate goals, because as a tax strategist, I can make sure that we are leveraging the right strategies that accomplishes more than just the goals you have for your business. Which leads me into your business goals. You may have a goal of incorporating or hiring employees or taking a home office or traveling more, or a goal of not paying 15.3% in self-employment tax that you're currently subject to. My goal is to make sure not only that we eliminate the self-employment tax, but we come up with strategies that are going to put your company and your business in a better position. With circumferences, choosing the right entity structure, whether that's an LLC, an S Corp, or a C Corp, I want you to understand the differences between each entity type so that you are educated as a taxpayer and that we are not just leveraging strategies, but we are educating you at the same time. Real estate is another goal that we want to know about. We work with a lot of real estate investors, and one of the many benefits to the tax codes is that the tax codes are set up to benefit those who are not only income earners, but also real estate investors. If you happen to be a real estate investor, you are sitting on an opportunity to leverage cost segregation studies, which is accelerating depreciation, but also management companies if you're managing your real estate to any capacity. From what we've talked about already, you are managing your real estate. However, you're not leveraging your real estate like a business. One of the things that we can do is put you in a better position where you're leveraging your real estate like a business for additional tax savings, but also the ability to incorporate your family who could be on payroll through a management company. Going past real estate, we go into retirement goals. A part of real estate could be your retirement goals, but if you happen to have retirement accounts, we need to know about them. Part of the reason why we need to know about your retirement accounts is because we need to know how much money you're contributing to a retirement account on a yearly basis. And we also need to know what you may not be contributing to a retirement account on a yearly basis, because this could be an opportunity to help you plan for the future. Not to mention, it could be an opportunity for us to help you reduce your tax bill. Qualified retirement plans, although it is putting money into a vehicle that can't be touched till later, is a way for our clients to reduce their tax bill. However, some of our clients choose to self-direct their retirement accounts, such as self-directing a solo 401k, so they can utilize that money inside the retirement account for investing in real estate or investing in business. If this is something that interests you, then we will have a discussion to learn more about your goals so we can implement all the strategies, not just the strategies that we see on the tax return. Now that we've had a chance to review your tax returns, your prior 3 years, we've had a chance to do a forecast for this year, and we've had a chance to go over your personal, business, real estate, and retirement goals, we are now in a position where we can present the strategies and the recommendations to you. I'll meet you at door number 3. Door number 3. Now that we've gone over your past tax returns and we've also looked at your current situation, now and only now can we present the strategies and recommendations that we feel would be best for you and your situation. These strategies will be listed in a chart-like format, one by one, so you can see how each strategy impacts your adjusted gross income, your taxable income, the amount of money you're actually going to be taxed on, and the date that we recommend that strategy. The reason why I say date is because when you're working with us in your second appointment and you're telling us more about the goals that you have for your life and what you're trying to accomplish for business, real estate, and retirement, we can make recommendations and implement strategies for you that we feel would be best to implement now, but also strategies that we feel would be best to implement later in anticipation for that new income or lifestyle that we anticipate you to have. This is where the intention gets set in the planning. We want to make sure that we are leveraging strategies not only for where you are right now, but for where you're going, which is why we give you our written recommendations. You will see that we have written out a game plan for you that highlights the different tax codes and the strategies and the tax savings that we have on the tax plan and that you desire. Not to mention, we read through these recommendations because certain recommendations may require you to live your life differently. We may have you use a separate bank account, or we may have you do different characteristics when you choose to travel as a business owner to make your trips deductible for your business. This is how we tailor our tax plans to our clients specifically. And after we've had a chance to go over these strategies, last but not least is for us to do implementation. I'll meet you at door number 4. Door number 4. Now that we've gone over these strategies, it's up to us to determine which ones make the best sense to implement now versus later. And after we've had that conversation, we can go ahead and move forward to implementation. Whether it's us helping you set up an S corporation to eliminate your self-employment tax, us placing you on payroll, or paying your child up to $12,400 a year, since we know that that's how much we can pay children without them needing to file a tax return. If it's us doing a cost segregation study on your property that qualifies for the accelerated depreciation, or if it's us setting up a private family foundation so you can roll over 30% of your adjusted gross income into your own philanthropic vehicle so you can receive a tax deduction, this is when we implement that strategy. So that way everything is tied together and you don't have to find a tax accountant that's going to do the implementation for you. This is what our clients love about planning. Not only do we take the time to ask the right questions, take the time to educate our clients, now our clients get to see and reap the benefits of the tax savings and the strategies together with us. After the implementation is over, our clients still have access to communicate with us as we are a trusted advisor. The $5,000, $10,000, $15,000 investment that you're making for tax planning is a tax deductible service that covers you for those 5 meetings, as well as ongoing consulting for the rest of the year. We look forward to being able to help you after this service with your taxes as well. Our tax preparation fee is, and our entity tax preparation fee is, most clients will choose to work with us on taxes after we've done planning because we've shown them how we can save them money on their taxes, and then we earn their tax preparation business. And this is why we love doing planning, because anyone can do the tax returns, but we would rather earn it.